Hello, welcome again to the ERM Advantage podcast. I'm Eric Holmquist. Today I am thrilled to have a highly respected colleague join me in the virtual studio today, Mr. Peter Dugas. Peter is the founder and CEO of Regulatory Intelligence Group, a boutique advisory firm specializing in regulatory intelligence to help financial institutions and corporate leaders navigate complex regulatory, political, legislative, and policy environments. Peter has over 25 years of experience specializing in geopolitical risk management, regulatory strategy, regulatory affairs, and government relations for the financial services and gaming industries. He previously held senior executive positions at the U.S. Department of Treasury, CDFI Fund, U.S. Department of Labor, and the U.S. Small Business Administration. He's regularly quoted as a subject matter expert and thought leader on financial services issues in American Banker, Financial Times, Fundfire, Bloomberg, Investment News, S&P, and Politico. And while you left out, heck of a nice guy, colloquially, he is my go-to person for anything that's inside the beltway that I need to unpack. So, Peter, welcome. I'm so glad you could be here today.
Well, thanks, Eric. I'm very excited about it.
So we're going to go through a variety of topics. And one thing I sort of pride myself on is when I see things coming out of the legislative or regulatory world, I've got a reasonably good ability to sort out what is sort of theater, saber rattling, or reality. And Peter is always my go-to on, okay, tell me what's real here. Now, Peter is a wealth of information, and I would love to spend a ton of time particularly kind of in the congressional world, but I want to sort of stay in the lane of this channel. And we're going to talk about some legislative and regulatory items, but we're going to kind of stay centered around what could impact financial services. And as an early tease for the listening and watching audience, I am going to be launching a new podcast in the coming months that's going to be more dedicated to all political content. So I'm going to sort of keep some of that in the bag, and we'll have you back and we'll drill deep into the insane world that is Congress and all of that. But today, like I say, we're going to talk better about the administration, about Congress, and really what's some of the stuff that's in motion. So I thought maybe a logical place to start, we're a year and change into a new administration. And every time administrations change, the winds change. Maybe you could just kind of tell us what's been the sort of the net effect since, January of 25.
Yeah, it feels like a lifetime, to be honest. I was actually going over some of my research and looking back, and I can't believe it's just been a little over a year, to be honest. I think what you could kind of summarize 2025 is the year of executive orders, the year of litigation, and really the year of reversals of many of not only the Biden administration's policies, but in fact, even going back to the Obama administration as well. I think what kind of shocked everybody in D.C., to be honest, was the speed at which the Trump administration acted. So when you recall the first Trump administration 1.0, there was a lot of challenges. Let's say, a lot of the political appointees that were coming in really weren't experienced and really, had to, move quickly as well as they could in order to affect policy change and the rest. But they really didn't have a deep bench of experience. Well, that's not the case for this Trump administration. As you saw with actions taken against the CFPB and others, really the Trump administration was able to move quickly. And that was really across financial services. So from that perspective, I think obviously we were, facing day-to-day whiplash. What I used to say is, I could do a monthly briefing to get clients up to date on what had happened over the last month, but really it became almost a daily conversation just because so much action was happening. And to be honest, they were very effective at what they did. Whether you agree with it or disagree with it, they have been very effective.
Well, and I think that's a fair point. And regardless of which side of the aisle you sit on, I think most people would agree that, man, this has been a whirlwind. And, in my perfect world, I think I might have wanted to stage some things a little bit more out, but I do think that some of this was necessary and starting to yield some positive results. But again, it's not without a certain amount of noise. Want to just sort of just touch down high level. We'll talk about Congress a bit. But do you see anything in the pipe with Congress that really could have a material impact on banking and financial services?
Yeah, the most immediate one is what's called the Clarity Act. So, as you recall, last year they passed the Genius Act, which basically built the regulatory framework for payment stable coins. And so, in response to that, they really didn't touch on the infrastructure side of digital assets. So, from that perspective, there's really a battle going on between traditional finance, traditional banking, and really the crypto companies. And that's really around a few things. But the most specific one for your audience is really around the payment of yield. So the concern by the banks are obviously if crypto companies, exchanges are able to pay yield, that will draw out deposits out of the banking sector and and into into the cryptocurrency sector, and technically to allow for traditional financial institutions to also benefit from things like payment stable coins, but at the risk of drawing out all of those deposits. Now, this report has been debated extensively on whether there's $6 trillion potentially at risk regarding deposit bases across the banking sector, and that's really what the banking sector has pointed to. But the digital asset firms do not agree with that. That is obviously just the total amount of deposits, but the infrastructure bill would substantially alter the ways in which both banking and DeFi would operate within financial services.
Yeah, and we're going to unpack some of the emerging stuff a couple of ways. AI, digital. Clearly, these are potential game changers in a number of ways, and we're very much kind of feeling our way around. So let's put a pin in that because I want to parse that out a couple of ways. For Congress, any sort of early thoughts on the midterms? Obviously, things are moving back and forth, but any early impressions?
Yeah, I think the Democrats have an advantage at this point. They're actually targeting more Republican-leaning districts than they have over the last several cycles. So they feel very buoyant and confident that they're going to be able to not just save the congressional seats where the Democrats hold the seats as of today, but then move into actually more offense and then actually go after some of these more Republican-leaning districts. If you look at the results of the special elections, which sometimes point to trends and sometimes don't. But it seems over the last several cycles, in fact, those special elections did point to trends. It looks like the Democrats do have an advantage in the House because the majority is not very many seats. It's 2+. Yeah. So at the end of the day, Democrats are going to have an easier time than Republicans will.
And obviously, there's a pretty decent suite of Congress people not running that have said, okay. Does that really influence anything, or is that just the game?
No, it does influence a lot because one, you just point to fundraising as a simple example. Their experience with fundraising, they can typically raise those funds. They understand the district better than any sort of a new entrant into the market, and they also are have the political experience and the bench of experience when it comes to politics and winning those congressional districts. So that is a substantial risk associated with the Republicans keeping the majority because of those factors.
Yeah, and if we think about it from a potential legislative standpoint, obviously Trump's not going anywhere. So worst case, if, say, Democrats control all or part of Congress, then we go into your classic stalemate sort of a scenario. There'll be a lot of noise. There'll be a lot of things. But it doesn't necessarily mean a lot of new legislation. It just becomes 2 years of yelling and screaming.
Yeah, unfortunately, that's going to be the case. It's going to be a lot of investigations. It's going to be a lot of looking at policies or basically trying to stop the Trump administration moving forward with rulemaking too, which I think for our audience here is the bigger issue. So even though Section 1033 and Section 1071, as an example from the CFPB, potentially moving forward with rulemaking, if Democrats control Congress, they have the power of the purse. While CFPB is not appropriated technically, but with that being said, they have other mechanisms in place that they can slow down the Trump administration from making change.
Yeah, and we're gonna talk about the agencies, including the CFPB, of which I have very definitive views, as I've expressed in prior podcasts. So we'll chat a bit about that. And I think what I'm hearing, and I think I agree, is that the way the winds are blowing is this, but November is a while from now, and a lot can happen. And again,
it's a lifetime. It's a lifetime of politics.
And particularly because of the pace we're at right now. So much is changing so fast. Every week is a new adventure, and and again, I'm never afraid to demonstrate my complete ignorance on topics. So you know that. It seems to me that the particular Republicans are reacting in different ways to what Trump is doing to ICE and tariffs and all of that. And is this part of an issue that's to some extent kind of dividing the party that, I totally support what he's doing. It might be noisy, but I support it versus I don't like what we're doing. And is that some of the erosion in support that you think that could influence Democratic outcome?
Yeah, it's pretty typical, though, at this point in administration. Obviously, the president's still very strong within the Republican Party. He still polls very, very well within the Republican Party. And I think the Republicans in the House and Senate recognize that. But I think the reality is for some congressional districts specifically, they have to have some level of separation. And so they're recognizing the fact, let's say for tariffs is a perfect example, they have to go a different direction. And just because the impact specifically to people in those either congressional districts or within the states could have an effect.
Yeah, and the 2 points that sort of adjacent to all that is I would love to go down the tariff path. I would also love to go down the gerrymandering path, but we want to be out here at a reasonable hour, so we're going to back pocket those for our next discussion. What I would like to do is, relative to Congress, is just talk a little bit about some of the committees and those of us that live in the financial services world. We know we've got the House Committee on Financial Services, of which the agencies report to the Fed, the Treasury, FDIC, OCC, CFPB, and you've got your Senate Committee on Banking, Housing, and Urban Affairs. So, again, we've got sort of, two different committees. We all know them, but I don't know that everybody knows. What do they do? So maybe you could just educate us a little bit on what are the roles of these committee. Obviously, they're part of the formation of potential policy and legislation, but sort of what happens in the chambers and what role do they serve and how do the two relate to each other?
Yeah, two parts to it, really, if you think about it. One is oversight. So of any administration, regardless of party, providing effective oversight over actions taken by any president in his or her administration. And the second part is really the administration of law. So with that being said, the House Financial Services Committee and Senate Banking Committee are very closely aligned in the rules that they operate under, which is effectively, looking at the banking system, looking at things like resolution authority, working at things like capital liquidity requirements. So they primarily focus on the banking sector side as well as the securities. And then the House and Senate Agriculture Committees cover the CFTC as an example. But, they're very closely aligned in policy and the ways they operate. What they really try to do is take a couple of views. One is the views of the majority, which in this case is obviously the Republicans and the Speaker of the House and Senate Majority Leader, and what his or her priorities are. So they focus on those specific areas. And then there's general Republican policy as an example. And same thing with the Democrats. They focus on their specific policy proposals, whether it's housing, immigration, or other specific areas within financial services. And really what they really try to do is understand through either congressional hearings, where they bring in witnesses who are subject matter experts or leaders of business or leaders of financial services to really understand an issue and really to dive into the details. So while much of it, as you've seen before, is much of it's theater, but behind the scenes, I'd say that's where the real work gets done, where you have congressional staff who meet with businesses, they meet with nonprofits, trade associations to really understand various perspectives on an issue and then craft specific legislation, and that is then viewed by the specific committee of jurisdiction and then make its way through the Senate or the House.
Yeah, and again, I'm not shy in saying that when it comes to the legislative world and how the sausage gets made, it's like, you don't want to understand the process because sometimes it'd be bumpy. And occasionally I'll watch some of the testimony and they'll have people like say testify that, oh, that's great, that I love that guy, that's great testimony. Some of it sometimes seems like a little theater, sort of pandering to interests. But at the end of the day, they are the formative body that's going to wrestle with new legislation and how we're going to approach some of this. And I think that sort of then tees up the related topic that I wanted to unpack. And as we've discussed previously, we've got some stuff in motion around emerging areas and emerging technologies, and a couple of the most predominant ones being obviously AI and digital currencies.
Yeah.
And so these are areas that I've mentioned in prior podcasts and other videos, and saying that one, I don't envy trying to put legislation around either of these, and I don't envy trying to put regulatory and guidelines and supervisor process around these, because particularly the whole digital world, because it's just a wild west right now. So let's take them one at a time.
Sure.
For the digital world, again, in a prior podcast, I had commented that I kind of like the way the administration is approaching this, of embracing the idea of how a blockchain technology could have a role in our financial ecosystem. I think it has some clever attributes, and obviously some of the larger money center banks are building their own blockchains, and the FISs and Fiservs of the world are building wallets to be able to work with a blockchain. So that makes sense. I think there's some smart technology that has some really interesting use cases. And I'm sort of open the idea of a tethered coin, so that it has stability. It is tethered to a fiat currency. I'm glad that we're not jumping in to embrace crypto, because that has some volatility. And I'm particularly glad that they said no go on a CBDC. I think a central bank digital currency would be devastating. I've written articles in this and saying, if you really look at the potential unintended consequences, this could be bad. I mean, this is a straight up sort of socialist tool. So all of that, just to strip that down to the essence of it, which is, considering how to use a blockchain and possibly a tethered coin, how is the committee and Congress thinking about this, and what is going to be a legislative role in all of that?
Yeah. So I'll take a step back for a second, and this is how long it takes sometimes for policy to be made. I mean, we were talking about Bitcoin, just Bitcoin and basically blockchain chain all the way back in 2010. They had several congressional hearings on it, including the Small Business Committee and so on and so forth, that I was involved with. That was in 2010. And we just passed legislation literally this past year, which was the Genius Act on payment stablecoins specifically. So that's how long it took for Congress to really take action. Now, several administrations have made policies and, proposed rules and guidance and everything else around blockchain and around digital assets and crypto and the rest. But really, this is the first piece of legislation really to cement a policy proposal and administrative regulations specific to payment stablecoins. So that's what we're talking about here specifically under the Genius Act, is the regulatory framework for payment stablecoins, which, to your point, will be tied to one-to-one, right? There will be a requirement that it'll have to have a one-to-one ratio in order for a payment stablecoin to be issued by a regulated financial institution. Yeah. So that's how long it took. That's just the payment stablecoins. Now we're going into the infrastructure side, which covers things like surveillance, blockchain, and other areas, which is what the Senate Banking Committee, Senate Agriculture Committee, and House Financial Services Committee, and so on and so forth are considering regarding the Clarity Act, which is going to be specific around the infrastructure side.
Okay. And I know that, we had a bit of a blow up a few years ago when the last notable stablecoin became untethered. And my understanding is that they've worked out some of the technical reasons why that happened. But is there some concern that it's tethered in theory, but not perfected?
Well, that's my concern. I don't think people are taking enough concern into account when it comes to the stability issues regarding things like treasury operations. Perfect example. I'll highlight this. And I think, if you look at like Coinbase and others, they're completely dismissing the idea that this could be a systemic issue. But the reality is, if it's going to be tied to one-to-one for short-term securities or, treasuries, as an example, if you look at what's happening now with, speaking of tethering, untethering is what's happening in Europe right now, and what's happening with China and other countries which are trying to draw down their amount of treasuries that they hold. And so because of that, there's going to create some volatility. So Treasury, the U.S. Department of Treasury, the New York Department of Financial Services, and so on and so forth, and as well as the New York Bank of New York, are not made to have 24/7 surveillance. And the concern for me there is that they don't have the infrastructure in place to mitigate any sort of liquidity event that starts taking place in Asia and they're not prepared
Yeah.
overnight to be able to address something like this. I mean, the New York Fed still doesn't operate 24/7. It
Well,
operates till 4:30.
and it
4:30.
I completely agree, and it kind of plays to a broader question, and it really sources from my concerns with a CBDC that in that model, you're now banking with the Fed, and so you now disintermediate the banks. Well, digital is a different animal, in that in many ways, digital currency is more elegant than a fiat currency because with a dollar, it goes through there's some clearing steps in the Fed, and so there's a certain sort of a lag there, which there's some merit to that. It gives you
Right.
a
Yeah.
second to
Agreed.
breathe and for oversight, as opposed to a digital, which is just boom happens. Now, with that as context, and so we have seen, very limited commercial adoption of this. It's mostly just sort of novelty use now, but there is theoretically some very interesting use cases, maybe like international clearing, things like that. So my speculative point is, okay, what happens? We have a blockchain, we allow for a digital currency, and all of a sudden everybody figures out this is a better way to do things. All of a sudden, does the Fed have less and less control over monetary movement and monetary supply? Is that a concern? Or is the thought process that if we're going to do a blockchain, it still has to bounce through the Fed? We still
Yeah.
have to have our
No.
fingers on it.
No, it's a good question. So I think there is a concern over the control by the Fed when it comes to both monetary policy and just capital and liquidity and potential events that could happen when there's systemic issues that take place within things like SVB is a perfect example. Why I saw somebody make the statement that it started in banking. Yeah, it doesn't matter where it started; it's still a systemic event. So it doesn't matter where it emanates from. It's just the fact that you have to have a control framework in place. So yes, but the one thing I would say is, there's 4,000 plus banks, 4,000 plus credit unions. So that's 8,000 plus financial institutions operating in the U.S. Of 99.9% of them that will not touch stablecoins because they don't need to.
Yeah.
When they look at the business case, the costs, and you'll appreciate this from a risk management framework perspective, to manage the risk associated with it, there's no benefit to them. So yeah, Morgan Stanley, Goldman, JP, and the rest will definitely look into this. But many instances, they're going to partner with exchanges or other firms to enable these stable coins. They will not issue their own stable coin, but they will use existing infrastructure because why make the investment themselves? What they'll want to do, to your point, is use the rails or use an exchange or use some other stablecoin company to be able to execute stablecoin payments.
Yeah. Well, it obviously raises questions about if suddenly the dollar isn't the way to go when I can
Yeah.
use a digital currency. And obviously there's been a lot of sort of noise about is the dollar losing its foothold as the world reserve, and like the brick stuff and gold and all that. I think right now that's a lot of noise, but I think it's a very fair thing to kind of keep in mind that are we sort of seeing digital as how we saw ATMs in the 70s? Oh yeah, a few people will use
Yeah.
it, not very many will. Well, now that's all anybody uses. So is there a scenario, and with any luck, not in my lifetime, so somebody else can worry about it, where all of a sudden everything is moving to digital? I don't see it anytime soon, but I think it's at least worth noting that digital does have some notable attributes. Let's take a similar tack on AI. And the nice thing about things like digital currency is it's a currency. So
Yeah.
the Fed's pretty motivated to make sure we get this done right and
Right.
don't let a horse out of the barn we can't get back in. AI is a little different because this is simply just technology, and so I think the government needs to be careful when you start legislating innovation.
Yeah.
So what is the thinking within committees around, can we legislate this? Should we? Or do we just sort of let it develop on its own and see how it ends us?
Yeah. I mean, good questions, right? And I'll kind of lay the what's happening right now. You have the Trump administration, which very clearly came out with its executive order and guidance to both states as well as just federal government departments and agencies on some mitigating or limiting factors on what they should or should not be doing when it comes to AI. So basically, they're warning the states is the states should not be acting in that it's the federal government's purview to regulate and manage, artificial intelligence as a public policy. So, but of course, the states, especially controlled by congressional House, their Democratic administrations are not listening, and they're moving forward with their own legislation. But to your point, what's happening in states like California and Colorado and others who have enacted laws related to AI, it's already outdated. So even the laws that they had passed in New York and other places are already outdated. So that's one of the challenges with regulating technology.
Yeah.
And then you have the Trump administration, limiting any sort of effort at the executive branch level to be able to, regulate AI. What we've seen is two things, and that actually just happened recently, which is Governor DeSantis in the state of Florida was going to propose specific AI legislation. Well, White House has already come out against it and said absolutely not. You should not be regulating in such a way. It's not in your purview. It's, the administrative responsibility is at the federal level. And then you've also had, most recently, Department of Treasury actually released two policies or guidance documents, really. One is around AI risk management, which is similar to the NIST framework for risk management framework. And then there's also been some other taxonomy guidance that's been issued. Other than that, it's been very limited outside of what NIST has proposed, or not proposed, what is finalized.
Yeah,
that's about it. That's what we have.
And again, this is another one where we're feeling our way around.
Yeah.
And I'm never a fan of legislating around innovation. I think you need to let innovation be innovation. And I think from where I sit, I'm really would not be excited about let's put laws around this, because what are you doing? Are you kneecapping it? Or are you just trying to create some friction? I think I'm more intrigued by how we deal with it from a regulatory standpoint. We'll come back to this.
Yeah.
Because, when I talk with clients and people and how they're using this, right now it's very sort of exploratory. And no institution that I've talked to has any intention of putting AI in place where they can let it go and do its own thing, using a lot of for better, faster, cheaper type implementation, which is good. So I think in that case, sort of my perspective has been, I think I'm more concerned with loss of quality than loss of control. If you just take whatever ChatGPT said and say, yeah, that's fine. So I think there's some definite ways we need to think about how we supervise its use. But I think if we try and put legislative rules around this, to me that just seems like a bad idea. But again, early innings.
Well, it cuts across what we're talking about with virtual currencies and Bitcoin, and because if we would have regulated Bitcoin as an example, it really wouldn't have considered things like a stable coin. It would have considered other technologies. So it's almost better to think about the outcome and the way it's used rather than the technology itself. Because when you try to regulate technology, it's always outdated in a very short period of time. That's always been the challenge with public policy or legislation or even regulation to a certain extent. But the one thing I have argued with clients is governance. You got to start with governance. Like, people are jumping to buying products. They're jumping to buying vendors, solutions. And I'm like, wait a minute, what's your governance framework? How's it mapped into your ERM framework? How are you supervising it? Do you have the technical understanding and the knowledge base and the subject matter expertise to manage and mitigate this? And what about model risk management and the rest? And they just kind of like, we haven't done any of this.
Yeah. Well, and I'm not going to go down the path of I have perspectives on our current Congress people and say, do they know how to create legislation around AI and crypto? Oh dear Lord. But I appreciate the fact they are certainly bringing in subject matter experts, and I think people, they live and breathe this stuff, and
they have to. I mean, because the reality is, and I'm saying this now around digital assets and the rest, if you look at the number of large financial institutions, mostly tier one banks, who are hiring subject matter experts to implement payment stablecoins and all the rest, there's going to be a big gap at a certain point between the people who are competent and capable, who really understand digital assets across the board and crypto and all the rest. And we saw this with ESG and all these other areas where, it's not new anymore, but it's really going to be a limiting factor that you're not going to have the subject matter experts across the industry to be able to effectively address it.
Yeah. Let's move to the regulatory environment, because I think this is an area where now we're straight into the financial services sandbox. Again, under this administration, the winds have shifted. So maybe just kind of give us the broad landscape of what's happened in the regulatory environment, and what do you see happening?
Yeah, again, to the frustration of probably many in your audience right now, everybody's so focused on crypto, it probably is the reality of what they're having to react to. But really, they're like, what do we care? So we're never going to do this kind of stuff. But that's the kind of the reality of the regulatory side. Because you look at, for example, the SEC, I think almost 40+% of the regulations they're going to be issuing in 2026 are all digital asset or crypto related. So
Wow.
it does really help, traditional investment banks and others. So when it comes to banking, we're seeing a couple of things. One is Section 1071 and Section 1033 as an example of being reproposed. They're going to have to get those finalized before the end of probably the next year or so, because there's something called the Congressional Review Act, which is essentially when a new administration can come in and potentially rescind a rule, like they did in the early days of the Trump administration for overdraft, as an example. So they're going to have to push forward with Basel. They're going to have to push forward with Section 1071, 1033. They're going to really have to submit many of the housing policies that the president's been primarily focused on. The big challenge, what everybody's debating right now, is this whole credit card situation, and whether that's a legislative vehicle or a regulatory vehicle. There's no real way to regulate credit card interest rates. It really has to be authorized by Congress, but Congress has not been very interested in 10% cap on credit card interest rates, as an example.
Yeah, well, that I didn't love that when it came out because
Hmm.
it sounds good on paper, but
Yeah,
obviously has ripples. And
yeah,
when you're anytime you're talking about things like that, you pull that lever, you just got to understand there's a trap door over there. And
yeah,
again, I get it played to an audience, but I think we should have some caution with that.
for sure.
I am kind of curious. I know one of the things the administration did was put the brakes on the CRA changes, and honestly, I didn't
Mhm.
like them. I thought a lot of them didn't make a lot of sense. Is that in the grave, or do you think they may come back and restructure that and revisit CRA modernization?
I think they will. I think the Trump administration specifically wants to address this and as soon as possible, because the reality is what the Biden administration proposed was not well received by anyone. Even the people who were supposed to be the supporters of it. It was probably, and I'm not exaggerating, probably the most complex regulation I've read in, I couldn't say 40 years, I'd have been 10 years old. But, within the last 40 years, there's been no regulation that's been as complex for the financial services industry to comply with. Full stop. It's literally just wasn't feasible. So I think most in the industry welcome, and I don't know if this means they go back to the original OCC proposal. If you remember that under the previous Trump administration, where the OCC did a standalone measure for CRA and proposed something that the industry, was okay with. Whether they do that, but they're going to have to move quick.
Yeah, yeah. Other than that, anything else in motion that's just worth keeping an eye on?
Well, I think, everything's really related to right now is cementing into the administrative law around everything from supervision and examination. As an example, you saw the Federal Reserve really, lean forward and really focusing on how they could do things like reputation risk and addressing that. And I think the Fed actually did it within the last week, has released a, final proposal in order for that to be something that they would have as a formal policy for any administration moving forward. The other one is obviously around the areas of debanking, as an example. Where that ends up, it's really going to be cross cutting with other AML BSA issues, which we've seen the Trump administration really focus on. And, that creates a challenge too, because what I say is deregulation is still regulation. So while you're having to comply with complex banking issues, that cuts into your AML BSA program, where there's been increasing scrutiny in things like, whether it comes to supervision of criminal cartels and other areas. It really creates a unique challenge.
Absolutely. I know that as part of the governmental cuts and streamlining some operations, I know there have been some cuts in
Hmm.
the supervisory agencies, as well as
Yeah.
just the regular retiring, things like that. I had heard that they were stretched a bit thin in their
Yeah.
supervisory abilities. Is that still the case, and they're going to adjust for that?
Yeah, they are pretty stretched. And I think, again, that's why I pointed to the fact that I think people were surprised how effective the CPB were, especially when they had such a large drawdown in the number of employees, whether it was through RIF or other attrition mechanisms. They still were pretty active in that respect. But I think when it comes to examination, you can look at it two ways. One, that banks and credit unions and the rest are enjoying the fact that they've, probably extended some of the timelines. But it also creates a challenge where now banks have to really be focused on it, 24/7, because it's such a long window that they can't be, can't ignore it and then kind of say like, oh, we'll go back to how we did things before. That's really not the case. And the other big concern for everybody with the supervision environment right now is what happens in 2.5 years when there's a new administration, which they're likely going to do two things. One is reverse everything the Trump administration did, which they can.
Yeah.
And the second part is, do they go back and examine every one of those activities that a bank or credit union undertook during this administration and say, hey, we're going to do a look back. And you know what? We're going to fine and penalize you for all of these things that you should have done and you should have known you should have done.
Yeah, obviously, a recent podcast, our mutual colleague John Safronov, who very, very wisely, said, "Hey, words of wisdom here. Don't get complacent.
Yeah.
It may be good times, but the winds shift, and continue to march to the standards you've always known."
Yeah, I mean, it's nice to have an extended exam cycle, but the complacency is going to kill you.
Yeah, exactly. I want to just go into my provocative category and some comments I've made in recent podcasts. Again, I've never been afraid to say the weird thing out loud, and I welcome people to challenge it or even give me a different perspective. But I'll throw these out there because this is very close to the world you're in. I have long been critical of the CFPB, in part because, again, I question its constitutionality, but more importantly, I don't see if it serves a unique purpose when the other agencies could oversee financial harm, consumer harm and consumer protection.
Yeah.
And so I've argued that we could just eliminate it. And I realize, again, that's provocative, but I don't understand the incremental value that they bring that other supervisory agencies couldn't do. But I don't know, what's your view?
Yeah, I don't think really the states could step in as much as people would like them to be able to address the various, areas of supervision when it comes to especially like things like fair lendings and, UDAP and others. I think the reality is, the states have an important role, but really at the end of the day, I don't think they would really be able to step in to address the critical gaps that, we have seen, especially from, things like supervision examination of non-banks as an example. They just don't have that ability.
Yeah, and that's a good point. And in fact, a colleague had mentioned in your reaction to my observations is, they have taken the lead on doing some supervision of non-banks or fintechs. And okay, maybe that could be a role. I could still argue that could be done within the other agencies. But again, if they do end up having a sort of a unique value prop, then okay, maybe we could talk. I think part of what bothers me is a lot of what I see just ends up being just a lot of sort of fines and penalties, but did anything really get better? But time will tell.
Well, if you saw the most recent report from the White House, they would say that, the CFPB's cost both not just the banking and credit unions and non-bank sector hundreds of billions of dollars, but also consumers as well. So, there's that argument. And now how much is that political theater versus reality? Hard to say for sure.
Yeah, and then my other sort of controversial take is I continue to question, and I have for a long, long time, why we have 5, 6 supervisory authorities as opposed to collapsing those, into one or two to supervise institutions. Just any perspective?
Yeah, I mean, that's bipartisan. Republicans and Democrats have been questioning that for many, many years and decades, in fact. So I think people would be open to it. The people meaning, certain members of Congress and the congressional committees of jurisdiction. But I think that's also the same issue is that committees of jurisdiction are not going to be willing to give up their oversight of those regulatory authorities. So that is going to become a challenge. But the reality is there's no reason why most of the agencies couldn't be absorbed into each other. And that's not a political statement. That's not even, that's just a logical thing to say the CFTC and the SEC as a perfect example should be integrated together because there's functions that are so similar. While yes, they have oversight over different sectors of the economy, but the functions of the agencies are very similar, and in fact could probably be better coordinated. I've always argued that's why the FSOC should have been more effectively used, but has never been.
Yeah, yeah. Well, and I guess it helps that they fundamentally are all supervised by the House Financial Services Committee. But again, I realize that I can say this. It's an easy thing to say, and it's easily said, but would not be easily accomplished. But I do hear from clients that what the Fed is asking for is different than what the OCC are asking them for, or the FDIC.
Oh, yeah, for sure.
I think the industry would appreciate it with some consistency in supervision.
Yeah, I'm sure they would. The challenge being is it's very difficult for people to give up authorities when they've had it for so many years, whether it's a Republican or Democrat. That's just kind of the reality of how the government works. Once it's created, it's very difficult to change. The only one who's really done that successfully was the UK after the 2008 financial crisis.
Yeah, and I can also appreciate too that while this, to me, again, living and breathing within financial services has some merit, Congress also has arguably bigger fish to fry, and this could fall in the heading of don't fix what ain't broke. Is it broken? Yes, but is it broken as much as other things are broken? And then finally, would you want to touch the hot potato of the credit union charter and the disparity in how credit unions are taxed versus commercial banks?
That's been a debate for decades here in DC, and I don't think that goes away. Obviously, the credit unions have their supporters here in Washington, but so do the banks. And so, unfortunately, I think it's something that's likely not going to change. And, there's really not going to be any tax vehicle that's available to the banking sector to be able to argue whether it's the ICBA or ABA to, make changes effectively to the credit union charter and the fact that they should be taxed like a normal corporate entity should be. But, that's kind of, it's basically just something that people continue to fight and argue over, but there's really no avenue to make those changes.
It just seems like it's functionally, the two dogs barking at each other, and after a while they just get bored and go off and do other stuff.
Yeah. I mean, they'll move on to the next thing, which would be tokenization or, whatever other issue that we have to talk about.
All right, so let's come back into the world of practicality. That's just fun.
Yeah.
Again, sort of speculation fun, but so then picking back up on our emerging, topic we talked about from a legislative view, and for the areas, particularly the trickier ones, AI and crypto and all that, from the regulatory supervisory standpoint, I mean, clearly they'll have to get some sort of legislation to work off of, but from a guidance standpoint, from a supervision standpoint, how are they thinking about supervising this edgier technology? And again, are they going to be able to really supervise it?
Yeah. Specific to AI or
let's start with AI.
Yeah, so the president in his executive order and various proposals he's put forward to basically the public, which is effectively how he's guiding the various agencies to think about this. There's two ways to think about it. One is how internally they think about it, meaning, how the Federal Reserve, the CFPB, and others use AI in order to do supervision or examination, as an example. In fact, the Fed, I think just today, actually, there was a speech on exactly that. So there's the internal operational framework for the regulatory agencies to think about how they would use AI. So that's the internal side. And then the external side is really looking at it a few different ways. One is the infrastructure. What infrastructure does, broadly the U.S. economy need in order to be, the leader in artificial intelligence? So that's kind of like the economics. And then there's the energy side to it as well. Yeah. And then kind of the third bucket is the regulatory side, which is, I would say it's definitely more of a hands-off approach. Let's say they hadn't rejected really the NIST framework, which I think people were happy to see. So as you may recall, NIST came out with the AI risk management framework. That is the predominant way in which most financial institutions, manage and mitigate risks associated with AI. Again, Treasury just released that report and guidance. That's really how it's going to be. It's going to be a little bit more piecemeal. Because to your earlier question, they're trying to understand AI. It's moving so rapidly and so quickly. So even if you took it like think about AI agents versus traditional response mechanisms within an artificial intelligence and modeling, there's going to be different ways in which they do it. There was a fair amount of evidence produced by the Biden administration, though, regarding AI, which has been all withdrawn by the Trump administration.
Yeah, and continuing down this sort of same vein, when I look at the banks, a few are incorporating it internally. They're building their own engines or whatever, but the majority are using a fintech. They're using some sort of third party, and I've been advocating for some time now that the regulatory agencies, the supervisory agencies, have started to more oversight of some of these third parties.
Yeah.
I think there needs to be a lot more. I think they really need to be drilling in. This seems to really sort of accelerate that, because the risk isn't going to be with the bank that uses it. It's going to be with the company that's building the tool with it.
Yeah, and the community banks, especially the ICBA and others, have raised that concern with regulators as well, that they need to, because that's how a lot of the community banks, they rely upon the U.S. government and U.S. regulators to really examine those institutions and those third-party companies that are very large, like an FIS, a Fiserv, and others, in order to make sure that they have the mitigants in there and the infrastructure in there to manage the risks associated with AI. They just don't have the technical capacity, the staffing. They don't have the expertise to really do it themselves.
But at one point, I thought I heard that one of the agencies, it was the Fed or SEC, was really ramping up teams to be focused specifically on supervising fintechs.
Yeah, so that was the Fed and others had the novel supervision program, which actually the Trump administration just basically drew down to say that, hey, we've done our lessons learned, we've done the staffing models to understand, okay, who do we have that are the technical experts within the agencies to be able to manage these kind of specific risks that are more novel in nature. And so the Trump administration argument is that we've done this, we're prepared, and now we have the staffing and then we have the staff modeling that can do this kind of work. So they think they're done.
Okay.
So that's their argument.
Well, we'll see. And then the other piece then is sort of digital. Again, it is fighting gravity to think that we won't have a digital element to our financial ecosystem. There will be a blockchain. A certain amount of commerce is going to start to be done on a blockchain. So how are the supervisors thinking about managing this within institutions? I mean, again, do they really understand the risks, and are they gonna be able to properly supervise institutions using this emerging, payment capability?
Yeah, I mean, that's to be honest, I hate to say this, but that's probably where they're spending a majority of their time right now, is on exactly that. Because it's not only once the passage of the Genius Act, each regulator, Federal Reserve, the OCC, FDIC, are now required to implement their own infrastructure around the way in which they will regulate digital assets and cryptocurrency and payment stablecoins and others. So they're actually going to have to come up with both a licensing framework and an oversight framework at each one of these regulatory authorities. And then they're trying to bring in, obviously now, with the potential passage of the Clarity Act, then that will cover the infrastructure side. But that's the way they're approaching it. They believe they have the capability to provide effective oversight. It's a question. It's a question for sure. So we'll have to see.
Yeah, I'm sort of torn, because there's a part of me. In fact, I made a mention in a prior podcast. I took a loving poke at the regulators, because I think they could do a better job in looking at banks' risk management programs. Yeah. And I said, hey, call me. If you want to talk about this, I could help you structure a program. There's a part of me that will say, yeah, I could help you think about how you supervise this. And there's another part of me that says, let's see, I'm going to retire in X number of years. This sounds like a somebody else's problem kind of an issue. But I don't envy them having to come up with, again, guidelines around these emerging, because these are some really complex technologies that, again, could change both the sort of the complexion and speed of the industry.
Yeah, I mean, that was the the vice chair of the Federal Reserve's argument for releasing the exam manuals, was exactly that, is both to inform and educate the people that they're supervising, but then also have broad policy discussions on, is there effective oversight when it comes to things like either compliance, risk management, how are they delineated between the two? What, I mean, you've heard this before. It's like some financial institutions argue they don't need an enterprise risk management program. They're too small. It's not necessarily. And some will argue that, oh, that's absolutely not the case. It doesn't matter what size you are. So that's going to be a continued debate.
Yeah. I want to hit kind of a basket of beltway topics. This is sort of a potpourri of some different sort of things, but this is really helpful because, again, so much is in motion right now.
Yeah.
And again, I think I've got a pretty good beat on what is just theater versus what's real. But for financial services, I mean, one change can have a profound impact. But again, within the beltway, I mean, obviously there's been a lot of cuts from some of the Doge work and just generally trying to trim different part of the administration. Is that going to continue, or is that sort of stabilized?
I think that's stabilized. I mean, I think now at this point, so a couple things to put in consideration is one, we're getting close to the elections. And so you really only have another like 4 or 5 months before the Senate and House to really act on any legislation in any real meaningful way. And then, once the midsummer time comes, then everybody's focused on the congressional elections. And that's the reality. And I'd say, the Trump administration at that point will be trying to push out the regulations, either notice proposed ruleMaking or final rulemakings as quickly as they can, because they're going to recognize the fact that very shortly, if there's a change in control, even if it's just one branch, it can slow things down tremendously, whether it's investigations, whether it's appropriations, or, just other policy disagreements that are going to slow down their actions. Not to mention the nomination process, which I know you had questions around Cook and the rest, but and Warsh, but that's going to be something that slows down as well.
Yeah, and that's a good transition. What are your thoughts on the likely transition from Powell to Warsh?
That's going to be a challenge. I mean, right now, the senator from North Carolina is holding up that nomination until the investigation is complete. And when is that investigation going to be done? It's going to have to be done within the next 4 or 5 months. So, in order to, because what happens, they have the Senate confirmation, the nominations. I think the nominations already been sent up. Then they're going to have the Senate hearing. There'll have to be an investigation into Warsh, which he's already been through all this. So that's not a big deal at all. So he's already been, vetted by both the Congress as well as the agencies. And then they'll have to have a schedule of the votes. And as I said, with the election coming up, Democrats are going to try every way possible to hold up that nomination, not to mention the Republicans who potentially oppose it as well.
Yeah, and look to the betting markets. Is Trump going to be able to get Cook pushed out before that's all complete, the full investigation? Or
yeah, I mean, they haven't been very successful. I'd say they've been a little challenged with being successful in these type of investigations because it is a very narrow area where they're stating that she committed potential fraud, and who knows if it's true or not. But
right.
That's the statement by through the investigations. But they've had challenges with these type of cases, so it's going to be hard to know for sure until the Supreme Court act.
And I know there's been some noise. And again, sometimes I just know what I read in the paper. That historically Warsh has been more of an inflation hawk. He's been more pro high rates, but now he seems to have sort of changed his tune. Would you characterize that as really a change in tune, or more just reacting to where we are right now?
What's a reaction to where we are in the economy? I mean, that's kind of the reality. Even last month they were talking about stagflation. So, I think it really is changing with the economic indicators, almost week to week, which is creating a challenge. Because I think what's also happening is the AI investments are really confusing the numbers, and so people are misallocating the ways in which the economy is expanding or not expanding, depending on your point of view, because of the significant amount of investment made in AI. The infrastructure around it. But does that extend to the normal economy? And that's left up to the economists to say.
Yeah, we've got that swirling in our area here. There's a proposed AI data center, and people are just very divided. One side, no, we don't want this here, and one side says it brings in a lot of jobs, it's good for our local economy, and I think truth is somewhere in the middle. I had one sort of semi, provocative take, and again, just because I'm not afraid to put hard questions on the table, and with a lot of these different parts of the administration, it's all very clear this is a part of the administration. The one outlier is the Fed, and it's always been the Fed because it's a quasi-private organization, and one side argues that it's critical to central policy and management, and one side argues it's just a step towards socialism. And again, truth is in the middle.
Yeah.
I do think they serve a purpose, but I oftentimes do question: is it really the best scenario? Is there a model where at some point we need to bring it in as a part of the administration, or does it make more sense to keep it independent? And if it's independent, should it remain the structure it is, or is a better way to do this?
To be honest, there's two ways to look about it. I always kind of laugh at the discussion around this because at the end of the day, they're all political appointees appointed by the president, regardless of Democrat, Republican, Obama, Biden, Trump, whatever, doesn't really matter. Yeah. They're political appointees. So to a certain extent, they're not independent of the political stripe of the fact is that, they're conservative, maybe liberal, in the middle, whatever the case may be. So to say that they're completely independent isn't necessarily true. But the big but there is, it's worked historically well at the Fed. That's what would be my argument. While, don't always agree with certain actions that are taken, or whether it's a lower interest rate or other things, that's a personal preference for me. But generally speaking, they've been well informed. They've done well, generally speaking. They were slow to act on inflation this past cycle, but I think in many instances people were expected them not to do that because of the situation with COVID. And who could have known? To be honest.
Yep. Well, I guess at the end of the day, it would perhaps be fair to characterize it much like our political system. It's the worst one out there except for all the rest.
Yeah, exactly. Yeah,
that's a good way to say it. And so again, don't fix what ain't broke. But it's a fair question. Is it in fact broke? I've been talking with some folks about M&A, and it seems like there could be a scenario for some uptick in that in the current environment. Any observations?
Yeah, I mean, obviously the FDIC and others have updated their guidance on, specific M&A reviews, which I think is excellent news for the industry because some of it, to be honest, had no real economic benefit to both the industry as well as the effective oversight over the banking sector. So, yeah, I would expect an increase in bank M&A. I think the big questions there is obviously going to be over the next several months. How does the tax for the big, beautiful bill really come down on the ability for banks to merely make those acquisitions and informed investments in the next 6 or 8 months? Because I think once you start getting into next year, again, going back to the fact that Democrats get control, there will be more oversight over M&A specifically, and there will be congressional either investigations or there will be congressional oversight.
Yeah,
so it could slow down.
And on a related note, for a while, and we've watched this for a long time, in the fintech space, that fintechs divide into the two camps. One is to partner with banks to help, do things. And the other is, ones that want to be banks and in some case wanting to acquire banks.
Yeah.
That seems to have cooled a bit. Am I just missing it? Or is this just, it comes in waves?
I laugh because we've gone through so many cycles on the fintech side. I think when you and I worked together, and I think you may remember this around, let's say 2016, 2017, the banks were absolutely apoplectic about fintech. So there's no supervision, there's no oversight, there's no regulation. They were couldn't believe that, banks and examiners and, regulators weren't going after the fintechs. But then they realized they were like, well, they're not really competing with us. We thought they were competing with us, but the reality was they have some very narrow products, or they have very narrow solutions, or very narrow services that compete on us on the margins. But the reality was there really wasn't that much competition. And then they started partnering with them because then they're like, oh, well, why would I invest all this money on building out, infrastructure when I can just partner with a fintech provider, or I can, try to acquire additional deposit bases based off of our partnership with the fintech. And so they started recognizing that it was more of a benefit to partner with these companies. Now you're seeing a little bit of a shift, but again, most of these are very specialized, whether it's, PayPal, which is being sold, by the way, or supposedly trying to sell itself. But that also shows you the challenge in the market. PayPal has been around for a generation, and they can't figure it out.
Well, and it seems like, and I've seen some instances where an emerging fintech, they got hit head on with the compliance requirements, and they went, oh, wait a minute, hang on. So at that point, it does make more sense to possibly partner. So anything at any institution or fintech that's trying to sort of be a bank, I think as being more ankle biters than it is an existential
Yeah.
threat. But is there still a scenario where we end up with Walmart Bank or Apple Bank or Amazon Bank where they've got a big enough, presence that it could really be a threat to the industry?
Well, and that's happening. Within the last several weeks, there's been a number of announcements, and you've seen a number of these automotive companies talk about getting their own charter, which, listen, they've had a number of banks who had their charter specifically around auto lending as an example. But again, those are very specialized lending apparatus, specifically around a very specific area of the economy, right? Of which auto lending.
Right.
So I think it provides more competitions to banks, but so far what we've seen is very specialized novel bank charters that are going, going to the regulators to say like, hey, we want a bank charter, and here's our specific business plan, our business operations, here's our platform. Is it going to provide more competition? Yeah, but it depends on how you view it, right?
Yeah, yeah.
If you're a community bank, you're not happy about it. But if you're Honda or BMW and others, then for them they're like, oh, it just makes perfect sense.
Yeah. And then finally, we've talked kind of domestically, but obviously when we look internationally, kind of the world's kind of on fire right now, and there's just all kinds of things going on. Is there anything really bubbling internationally that could ripple inside of U.S. financial services?
Again, going back to the treasury markets, that's my biggest concern right there. And while it's been just a number of pension funds and other organizations and asset management firms and others who've acted against their treasury operations specific to U.S. bonds, but going back to your discussion around CBDC, so not to belabor the point on this, is the big concern there is, right, China and others are using CBDC because they recognize, with the U.S. being so successful with sanctions against Russia, as an example, is now meaning the regulators have created an incentive that foreign governments are now trying to create an alternative payment system. CBDC is an example of why they're trying to do as an alternative to SWIFT, so they can't be, sanctioned, as an example.
Right.
Similarly, with the treasury operations, I think that is a concern. Is what does the future look like? Is it just a response to the Trump administration, or is it a full-blown disintermediation between the U.S. and Europe? We don't know. I think that's the challenge.
Yeah, yeah. But that's, like I said, every day is a new adventure.
Yeah, that is for sure.
These days it is. We've covered a ton of ground, but before we, sign off, is there anything else, again, moving in the beltway world that's just worth noting?
The only thing I had mentioned to you before is the discussion around prediction markets. I think that's going to be a very interesting to see. To be honest, probably most of your viewers will not be very interested in prediction markets. And so for the folks who maybe are paying attention to it right now, the CFTC is going through a big fight with the gaming sector, specifically whether they have authority to allow for basically for sports-based contracts on specific exchanges. The CFTC is arguing that they do, and obviously gaming companies, gaming operators are arguing that they don't. And there's been any number of litigations that are already taking place because of it. But it's sucking up a lot of oxygen here in DC because everybody's watching this with, I would say, with speaking of novelty, with an interest to see how this ends up. But again, is it going to be one of those situations where it's only going to be regulated for the next few years while there's a Trump administration, or are they going to be able to formalize rulemaking, go through the courts, and be able to say like, no, in fact, Kalshi and these other prediction market companies should in fact be allowed to conduct those transactions. But we'll see.
I've got friends that are convinced that DraftKings ruined professional sports because the NFL is totally scripted now, and I can't get there yet, but I can't deny that the betting market hasn't had an influence, but is it a corrupt influence? I don't know. Let people smarter than me figure that out, but again, things change and we learn to adapt. So before we sign off, in addition, again, you've got an advisory service around regulatory issues. So maybe you can just tell us a little bit about your service, what it is you do, and who you work with.
Yeah, sure. Thanks, Eric. Sometimes regulatory intelligence sounds a little nebulous, but the reality is what I try to do is provide signal to financial institutions so they kind of understand the path and, the political and regulatory landscape and, what the regulators will be doing, not just now, but in the future. And then the second function is really around reg change management. So how they effectively address that in their regulatory change management program. And then the third bucket is really specific to government relations. How do they influence the public policy outcomes to be able to address those before something becomes a formal rulemaking versus necessarily just understanding it from a signal perspective. So really trying to provide that end-to-end view, from the signal to the implementation to the original to the actual policy outcome.
As always, Peter, you're a wealth of information. I can't thank you enough for your time today. I really appreciate you joining us.
Yeah, no, thanks, Eric. Appreciate the time. Let's continue the conversation, and obviously, let's stay in touch.
Well, I hope you found this episode informative. Once again, thanks for listening.
The ERM Advantage podcast is recorded at Lightshed Studios, Philadelphia, Pennsylvania. Copyright 2026 ERM Advantage, LLC. All rights reserved. To inquire about appearing on the podcast, please contact us at ermadvantage@gmail.com.